इसमें नहीं दिए मैंने इस पे।
Hello, check.
होम पे
Hello, check.
अच्छा ये पहले
हाँ
वाला
हेलो
है।
चेक दे दो।
Hello, check. Hello, check.
Yes. हेलो चेक हेलो हेलो लेके ये वाला भी अनम्यूट कीजिए अनम्यूट कीजिए
Hello, check. Hello, check. Hello, check. Hello, check.
मुझे दे दीजिए मैं इंट्रोड्यूस कर Yes, so welcome back to our fourth doctoral workshop, Fourth workshop. So we have Professor Kamran Kudus. So he is a faculty member at IIM Ranchi, and he has done his PhD from IIM Calcutta. And we have Professor Arun Bairwa. So Professor Arun Bairwa, again, he is a faculty member at IIM Ranchi in the economics area, and he has done his PhD from IIT Indore. The theme of this particular workshop is going to be the advanced quantitative modeling. So where Professor Arun is going to take a session on the logit modeling. And after that, Professor Kamran, so he's going to take a session on the event studies, right? Yeah, thank you, yeah.
Thank you, sir. Am I audible? Or it can be multinomial, means it can be having more than two categories. So like for example, rural, urban, which is binary. Another side, different levels of education, which is multinomial. So for that kind of the variables or that kind of the data, we mostly use either logit or probit, that kind of the techniques. So here we'll discuss for the logit model, in which first we will see for the the categorical, in which there is a two categories. So it is a binary. So the same can be extended for multinomial, in which more than two categories are there, or it can be extended to the ordered logit, in which there are multiple categories, but that can be ordered in a particular sequence. So for understanding the logit model, first we need to see the odds. Odds is the the probability of success divided by the probability of failure. So it shows like what is the odds of happening one particular event or not happening a particular event. So with one example, we'll start it. Okay, so one side, the basic condition is the dependent variable has to be binary. For the logit model, if suppose it is a multinomial logit, then it has to be, the dependent variable has to have the multinomial category. Independent variables can have any kind of the variables. It can be continuous or it can be binary or any kind of that. But it is compulsion that the dependent variable should be categorical. Then we are going to do the analysis. So one side we have dependent variable, which we also call as a response variable. Another side independent, which we also call as a predictor. And then the basic benefit of using the logit model is the probabilities we get, that will be ranging within between 0 and 1. Another side, if suppose we do it with the Euler's technique, the predicted values will not confine within 0 and 1. So will not be able to predict what should be the probabilities. But using the logit model, we can confine the probabilities between 0 and 1. So that we will see how we will do. Okay, so before going to the logit model, first the basic of that is it is coming in the odds. So odd is nothing but the probability of success divided by the probability of failure. Yes, probability of success divided by the probability of failure. So let's say, for example, an event's happening probability is 0.75, and or the probability is 75%, and not happening is 25%, or it is 1 minus the probability of success. So the odds are 3 to 1. Okay, and if we convert back from odds to probability, we can have it odds divided by odds plus 1. which mostly will not use. Mainly we will be using the like formula for calculating the odds, because from odds we will go to the logit. Okay. So for example, this is a 2 by 2 matrix. 1 minute. Let's say this is a 2 by 2 matrix here. So there are some values we are having for the success and failure. So for example, anterior MI. So this is, let's say it is a particular kind of the heart disease which is a particular patient is having, and then we are predicting the survival of the particular patient. So 1 is indicating the death, and then 0 is indicating the survival. Another side, whether the person is having that particular disease, which is also given in 0 and 1. Okay, so from that first we'll calculate the odds. Yes.
So in case of odd,
Yes.
we mentioned just difference.
Huh.
Difference between C and D on the odd position.
Huh.
It should come at A plus B place.
Where?
A and B difference should come at C plus D place.
Which one you are telling? A plus?
Yeah, that is why it is called as odds method.
Huh.
Difference of A and B, modulus value, it will come at C plus D, where you have written C plus D.
Yeah, no, so that I have done for deriving the another method. That is, like directly we can calculate the odd by multiplying A with D and B with C. So for showing that, I have like written in more detail. Okay, so downside you can see that instead of always going as probability of success or divided by 1 minus probability of success, we can directly have it as AD divided by BC, which is from this particular matrix. Simply we can have, so 120 multiplied with 2504 and then 2005 multiplied with 67. Then we will be getting the odd ratio. Okay, so when we are getting odd ratio, it will be like, see, it is in this particular case, it is coming 2.23. So what we do, because odds can range up to a very high values, we are taking the natural log of that. So when we are taking the natural log, it is coming 0.80. Okay, now from this 0.80, we calculate the probabilities of happening that particular event. So that we will show. So for that, the formula is, this is the formula for converting back from the logit to the probabilities. So both the formulas are same. Any of the formula can be used. So here we are showing this particular formula using which we will be calculating the probabilities. So earlier we have seen that this 2.23 is there. So here, yeah, so okay, let's say this is the odds we are having. So from that, we are taking anti-log of that and putting in the formula. Then we are getting a particular value 0.05. That is means the 5% chances are there of happening that particular event. By using the another formula also we get the same result. Any of that formula we can use. Okay, so that particular matrix we were having, from that manually we calculated. Using Stata also we can calculate. We'll be getting the same 0.085 as a like logit values. Then from this we can calculate the probabilities by putting it back into the formula. So it is 0.085 plus we are having the constant. The constant was also there in the original model. So when we are solving, if suppose see, this probability, the event is not happening, means this is given as 0.085 multiplied with 0 means the event is not happening. So that time what will be the probability? So it will be simply equal to the constant. So it is here downside we are doing it by putting in the formula. It is 0.026 means there is a 2.6% chances that that event will not be happening this, because with 0 we have multiplied it. Okay, so there is a simple relation between the odds and probabilities. So this I have calculated manually. One side, if suppose see probability, if suppose there is a 50% chance that the event will happen or not happen, then it will be, its equivalent in the odds is the 1. 1 shows the equal chances of happening or not happening the event, because odd has come from probability only. If the probability of success is 0.5 and then failure is also 0.5, then it will be overall it will become equal to 1. So that is what happening. So as our probability is going from 0.1 to 0.9, accordingly our odds are also increasing. So this is the relation between the odds and probabilities. Okay, if suppose our independent variable has multiple categories, then how we will interpret? So for that, let's say for example, same this particular disease, it has a multiple severity levels from 1 to 4. 4 is the most severe condition in which there is a very less chance of survival, but 1 has the very high chances of survival. So in that case, same way we can calculate the odds first, and then from odds we can calculate the logit. So it is done by Stata also. I'm showing it how manually it is done. So first we can calculate the odd for the level 1. It is 97 divided by 3671. It is 0.026. Same way for 2, 3 and 4th, we can calculate the odds. Now when we are going to the logit, that time we have to specify a particular reference category. Means whenever we are interpreting the results, we have to say that these are the results in comparison to a base category. So if suppose we want to say the chances of survival or not survival for the 2 or for 3, anything, but a reference is required. So let's say we'll keep first category as a reference. So compared to the first, what is the chances of survival if the person is having the 2 level of severity? So in that case, simply the odds of the second we will be dividing with the odds of the first level. So it is coming here 2.80. Second is the odds of being in 3 compared to 1. Here I have calculated it. So it is 4.33, and then at the last one, which shows very high level of severity or maybe the chances of death are very high. So accordingly, the odds are also coming 28. Okay, so when we do it with the Stata, with the logit command, same output we get. So now this is the odds, or we can say here odd ratio. It is outside written also. So for the command for it in the Stata is logistic, otherwise logit, then all the variables, comma, OR we have to put that OR. Then we'll be getting the odd ratios. Now from odd ratios we can convert it into the probabilities. Okay, there I have shown by keeping the reference as first category, but instead of first, any of the category we can keep as a base one. So for example, if 2 we want to keep as a base category, then what we can do, the fourth odds of the fourth divided by odds of 2. Then that way we'll be able to identify the probability of having 4th level of severity compared to the 2nd level. Okay, so the same is shown over here. The values which I have calculated here manually. These values, this is further again it is shown over here. So the first one, this is the odds, and then K2, it means 2nd level of severity, the odds are 0.74. So compared to the first, what is the chances of not surviving in the 2nd category is given by K2 by K1, means the odds of 2nd divided by odds of 1st category. Same way we are doing for all of that, and these are that particular odds. Okay, so odds when we are having, so mostly when we do the logit command, it does not show odds, it shows the log of odds. So which we can simply get by doing a natural log of odds. So these are the these are the odds, and we are taking natural log of that. So then we are getting these coefficients, which are called as a logit. Okay. Okay, so same again here, for each one we can calculate the probabilities. So for example, 2nd level, when we are having level of severity, then compared to 1, what is the odds? It is, see, 1.031, which is the value which is given for this, minus, means the constant also we have to put. Then whatever the output is coming, on that we are taking anti-log of that, and that is the odds. And then from this odds, or otherwise directly from this logit values, we can calculate the probabilities, which is simply taking the anti-log of that and putting in this particular formula, which I have shown again here. When we are again putting in this, we are getting the probability. So 6.8% higher chances of death are there in the second severity compared to the first one. In the same way, we are calculating for the severity level 3 and then 4. So that way we are calculating the probability for each of the different levels. So in Stata, the command is predict, using which we can calculate the probabilities. So predict, and then whatever the name we want to keep for that variable predicted, we can keep here. Or the alternate command is, I have written here, margin. First we have to run the logit regression. While running the logit regression, we have to put the I dot command to indicate that it is a categorical variable. Okay. Otherwise, margin command will not run. So margin, that command we have to give after the running the logit regression, and then we have to mention the variable name with I dot. Then we will be having the probability or predicted probabilities it is. So the predicted probabilities for each of the different subcategories. So the same it is shown here. So for K2, K3 and K4, the probabilities which we had calculated in the last slides. So these are the probabilities. So see, K4 is having 42% chances of not survival or like of the death in this particular example. Okay, so major thing to remember in this, whenever we are doing categorical data analysis, always the interpretation is made by keeping a particular category as a reference or the base category. So let's say in this example, instead of 1, we can keep the base as 3 also, 4 also, whichever we want, that particular category we can keep as a base. By choosing the base category, the interpretation does not change. So the interpretation will be same. Okay, we can also have interactions among the independent variables, which can be of like either binary into binary or categorical, or like any other combinations of that, or there are so many other combinations as well. And then using that, we can calculate the probabilities. But as the multinomial categories increases, it becomes little difficult to make the interpretations. Yes, thank you. Yes.
So if you could help us understand the Stata, interpreting the Stata outcome.
Stata outcome. Stata outcome is. Okay, for example, in the Stata, this output will be.
Sorry, if you can go to that slide where we have all the complete result, starting from chi-square. Yes, sir, this one will do.
So this is odd ratios.
So because I'm also doing this for one of my term papers, that's why I'm asking this. So I think, please help me understand. So if the probability of chi-square is less, then we will eliminate, like we'll just discard this model. How should I understand that whatever model I am proposing is
so for robustness check you are telling. So robustness check, different indicators are there. One is ROC, another command is GOF, multiple command is there. So one book is there, logistic regression, Hill-Bay. That author is there. It has clearly shown 5-6 different robustness checks. So that book you can read for that.
Sure. Thank you.
Yeah. Thank you all.
Now I'll just continue with the second part of this doctoral workshop. So I'll just be walking you through what exactly is an event study. I'm pretty sure that many of you would have used event study for some of your work. So what exactly do we mean by an event study? So unlike a normal calendar analysis or a normal time series analysis, here we have a set of finite events that we want to capture the effect of that event. Particularly this type of studies is used in corporate finance or for other measuring stock price data or some other returns associated with the event, okay? So assumption here is, one assumption that the study takes is the efficiency assumption, which means that if you want to measure the impact of an event stock prices, markets have to be efficient. And I hope that all of us sitting here must be aware of the concept of market efficiency. Market can be efficient at 3 levels. It can be efficiency in a strong form, weak form, or semi-strong form. Okay, the idea here is that if there is an event and corporate event which fundamentally alters the fundamentals of the company, that should be captured in the prices, assuming it's a listed company. Okay, so the effect of the event, assuming it has a material and tangible effect on the fundamentals or cash flows, it will definitely reflect in the prices. So any event, once it is announced and known to the market, will be visible in stock prices. If it's a positive event, the stock price is going to go up, okay? And if it's a perfectly efficient market, the prices will jump up instantaneously without any lag. If the market is kind of not efficient in the strong form, maybe then it may take some time before the market realizes that fundamentals have changed for the company, cash flows have changed for the company, and therefore it deserves a better valuation. So this is what we do in event study, okay? So I've just taken a simple example of how would, let's say, this is a very hypothetical example. BMW announces that it's going to come up with electric vehicles, okay? So we understand it's a positive announcement, okay? The moment we get to hear that something like this is lined up by a automobile manufacturer, it's bound to be reflected in prices. So here we have 4 possible scenarios in which this information can be digested or reflect in the stock prices of, let's say, BMW, okay? The first is, of course, the perfect, in a perfectly efficient market where we can see a vertical bump up in the prices. The moment the market knows this information, it fully reflects that information, the stock prices, and that's indicated basically by the black line that you're seeing here, okay? But if we just relax this efficiency assumption, then what we have here is 4 other possibilities that we very frequently see in real life market, okay? So let's walk you through one by one. So first is basically a slow reaction, which means market is very slow to react on the information. Maybe it has not digested the information as soon as it gets the information. There could be a number of reasons for that. Of course, if you just dig through the literature, you'll find ample number of reasons why that would happen, okay? The first I can just give you maybe the opaqueness of information. Maybe not many analysts will be covering the company, in which case people may not be able to quantify what effect a positive change, let's say the introduction of an EV, would have on the company's fundamentals, on the cash flows, okay? So in which case it's going to take some time before it's actually, the prices reverts to the efficient level, which is what is indicated by line 1, which is a slow reaction. Line 2 is basically the market has somehow anticipated it. Maybe there was a rumor, okay, maybe there was some leakage, okay? The market got to know before the management actually made it public to the news, okay? In which case we can see the stock prices started running up before the actual announcement being made by the management, okay? Which is what is indicated by line 2, which is basically, you can say it's, stock prices are running in anticipation of some positive news announcement. Line 3 is when the market overreacts. Again, this could be because of n number of reasons, and I would suggest and request you to go through the literature. There are a number of reasons for that again, in which case the stock price is actually overshot by more than what the fundamental deserves, okay? Let's say the actual change in the fundamental, or what the fundamentals suggest, is the prices should stick to this level, which is indicated by the black line. Let's say hypothetically, initially before the announcement, stock price of BMW was somewhere around, let's say, $100, okay? And again, I'm just taking hypothetical example. I know BMW is not a US company, so still I'm invoicing the share price in dollars. So let's not get bogged down by the details. Let's understand what I'm trying to explain. Okay, and then after the announcement, let's say the share price, it should have been somewhere around $125, but it actually went up to somewhere around $135. Okay, and let's say announcement date, I have indexed by time 0 on my timeline. Okay, and let's say by after 2 days, the stock, which should actually be at $125, is actually still trading at $135, which is more than what the fundamentals dictate. Okay, market will again be understand that's actually commanding it's overvalued at this level, and therefore the bubble will burst over the next few days, and then the prices will eventually revert to the efficient level. Assuming that markets are efficient, it will revert to the efficient level, which is what is shown by line 3. And line 4 is again a case where we are dealing with a market which is not efficient, okay, in which case the market will never be able to anticipate what the real change or how much share prices should actually go up following the announcement, which is what is indicated by line 4, okay, which is a very rare scenario in today's market. But theoretically speaking, if we are just discussing, we also discuss this scenario 4. So this is what we do in event study. Now, how do actually set up the model and measure these things that we have discussed graphically? Okay, so I'm just going to take a few econometric issues associated with the design of the study, and then I'm going to run you through a code which is actually going to get you all the results that I'm just presenting to you before, right now, okay? So now let's just kind of divide the different number of events that we are trying to study here under 2 broad heads. Okay, there could be events which are within the firm's control, which means a firm can influence that event, which is an internal event. Let's say BMW can choose to announce the introduction of an electric car after a month. Okay, that's well within the firm's control. Or it could be, or let's say an event of announcement of a stock split. When a firm chooses to announce dividends, bonus, stock splits, it's well within the firm's control. So that's first kind of event. Other kind of event is an exogenous event, which is not within the firm's control. Let's say how or when Fed will choose to hike rate, and by how much basis points is not within the firm's control. So it's more of a macroeconomic variable, which is well outside the control of any firm. So I'm going to put that into the second bucket, which is outside the firm's control. Okay. Now, using such a setup or design, what we can do is we can analyze the impact of a number of corporate events. For example, how much stock prices or how much valuation will change post any mergers or acquisitions, post earnings announcement, post issues of new debt or equity, okay, announcements of any macroeconomic variables. Let's say a Fed hikes rate by 25 basis points. How would the valuation of any automobile company change? We can do this using an event study, okay? Or similarly, we can study the effects of IPOs, dividend announcements, and so many other things. So this list is totally not exhaustive. We can go beyond this list and study a number of other things, okay, using this setup that I'm just discussing right now. I would not stick by the statement that's up in the slide, okay? Just a disclaimer that this slide and all the material that I'm discussing right now, it's in the public domain, okay? So that's, I would very loosely say that this technique is mainly used in corporate finance and not economics. But when we say that there are events which are outside the firm's control, for example, announcement of a macroeconomic variable, we definitely touch that boundary with economics. And therefore, this is a very, very loose statement, not to be taken very seriously. Please take it with a pinch of salt. Okay, there are a lot of issues that you are going to deal with once you do an event study for your research, for your paper. Okay, I'm just going to touch upon superficially on a few of them. Okay. Traditionally, a lot of studies have used event studies for a number of reasons, but first instance that has been documented is the one used by Farmer and French in the year 1969 when they were studying the impact of stock splits, okay? And then following 1969, a number of researchers started using event studies. So even if you just do a simple Google search, Google Scholar search, you will find that your results window will be flooded with papers which use event studies. So this is so popular, okay? These are again a list of studies just to give you a flavor of what different authors have done using this methodology. So for example, Brown and Warner in 1980-85, they used it for short-term performance studies. Lugran later in 95 used it for long-term performance study. Babar, Leon, Babar and Sai use it for long-term performance studies. Okay, and likewise, there are several review papers on this, which basically discuss what are the issues when you actually use event study as a technique for your research. Okay. So what is the step? How do you actually carry out an event study? These are the number of steps, okay? So first, you have to define that event. So that event has to be very, very clearly identified, right? So it should be clearly identifiable. So these are the events, and you want to study the impact of these events on something, let's say stock prices, okay? So this has to be clearly identified. Second, selection criteria. So on what basis are you going to select those events? So there has to be concrete selection criteria. The reason I'm emphasizing on these things is, as you go deeper with these studies, you will realize that each of these steps will actually pose some econometric issues with your study, and you have to be very, very clear, okay? Third is, how do you measure normal and abnormal return measurement? I'm going to emphasize on this part. I'm going to walk you through a few models which actually are used to calculate normal returns, and the moment you know what is normal, you automatically know what is abnormal return, okay? Then what is your estimation procedure? How do you actually estimate? What are the testing procedures? Luckily, testing procedure here is very simple. You tend to measure abnormal return, and then using a simple test, you test whether your abnormal return over, let's say, a 3-day window or a 4-day window is whether it's statistically different from zero. It's so simple, okay? And then empirical results interpretation is normally what you do with your results, okay? So this is the timeline. I've just drawn this timeline, assuming that we are studying a simple, let's say, dividend announcement, okay? The dividend announcement was made on time 0, which is what is indicated by that index 0. So normally this index 0 is always used in these kind of studies to indicate the event day, okay? And then there are days before the event day, for example, T0 and T1. These are days prior to the event day. And as we have seen in the first, the second chart itself is that there could be 4 reactions, which is what I have indicated using line 1, 2, 3, and 4, okay? And that's the reason why we have to take 2 time points before, 2 time points after, right? So likewise, we can have T2 and T3, which are basically post-event times, okay? So you can choose a window. Let's say I have chosen interval T0 to T1 as my estimation period. Why I have done that? Because I need to have some benchmark against which I would want to compare what impact that announcement or that event had on, let's say, the stock returns, okay? And therefore, I need to have a benchmark. And this is where that estimation period helps me get that benchmark line, okay? T1 to T2 is basically the event window. Is basically, I would say the event window is when the event happens, okay? I've chosen this T1 to T2 could be very narrow, okay? It could be 2 days, it could be 3 days, or it could be even as small as a single day, okay? So just remember that everything should have a justification, because it will pose an econometric issue the moment you choose something, okay? Time 0, as you have suggested, is basically the event date in the calendar time. And the interval T2, T3 is the post-event window, okay? And generally speaking, there's a good habit that you need to have a cooling period, which means that your event should not affect your, let's say, post-event analysis or pre-event estimation of benchmark line, okay? So therefore, we need to have a cooling period. And if you have seen in papers where we generally do portfolio studies, we also see there we need to have at least a 7-day cooling period before we start measuring the return, okay? We generally, for example, rebalance our portfolio every month, and then we see what is the portfolio return in next 3 months, 6 months, 9 months, 12 months, but we allow a cooling period of 7 days. So that's the idea here also. I think I have spoken much about this, so I'm going to skip it. Yeah, so again, from the perspective of, I have clearly segregated that events could be of two types, initially two types, one within the firm's control, one outside the firm's control. Likewise, when you use such a estimation technique for carrying out some analysis, again, it could be used for analyzing, let's say, stock performance over short horizon, or it could be analyzing stock performance over long horizon. Remember that the objective here, when you do a post-event analysis over a short horizon versus a long horizon, the objective would change, okay? When you do a study over a short horizon, the idea is to see how quickly information gets assimilated into prices. That's the idea. But when you extend your let's say post-event period, then the argument again is whether the market is efficient or inefficient. Because if you remember, go back to the chart that I have shown, BMW's chart, we had 4 lines, line 1, 2, 3, and 4. So you can see that line 4 and 3 was basically, line 3 was basically talking about slow reaction, line 4 was inefficiency. So again, if you want to check for efficiency arguments, you will have to work over a longer period. Let's come to how do you measure the normal performance. Remember, in order to find out what effect an event will have on your, let's say, stock prices, whether that effect is normal or abnormal, you can only judge when you know what is supposed to happen, okay? For example, if BMW announces electric cars, okay, introduction of electric cars, you should be aware how should the market react, okay? Whether the market should go up, or whether the stock prices should go up, whether the stock prices should remain flat, or it should just cave in, okay? So only when you have a fair judgment of how, what is the normal reaction to an event, only then you will understand what impact that specific event had on the stock prices, okay? And therefore, we need to measure what's the normal performance, okay? So luckily, what we do is we, in a very simple form, we introduce a model like this. We say that, okay, the return that you expect is nothing but the expectation of where the stock prices would go given the current set of information, which is given by the vector x. Okay, so x represents the vector of current information, let's say current cash flows, current fundamentals, etc. This is where the prices should go. Okay, and of course there is an error term, let's say zeta, it's a Greek term. If I am not pronouncing incorrect, it's called zeta, right? So here x is the conditioning information, which is basically again all the set of current information that the market currently has. Okay, so in event studies, what we do is we focus on this error term, okay, which is where we get to know what is the abnormal return beyond what is normal, because expected R, that's the first term, is what is normal, and therefore what is left out is the abnormal, okay, which is captured by the term zeta. Okay. It's called abnormal because it's the unexplained part the model cannot explain. We have come up with a model. If we come up with a CAPM model, we have just one predictor, which is the market factor, and we have no other predictors, and therefore what is left out is abnormal, captured by zeta. Again, there has been a lot of debate, research on how to correctly specify your benchmark model, because it makes hell of a difference. Okay, because if you use a simple CAPM model, maybe you leave too much to the unexplained part, and therefore your zeta naturally will be, let's say, overhyped. Okay, but if you use, let's say, our French 3-factor model, you have 2 more predictors, right, beyond just the CAPM factor, market factor. Okay. In which case you leave little to the unexplained part, okay, and therefore you have to specify the model perfectly. Now this is just the statistical assumptions. If you assume that the returns that you have calculated for your stocks, if they are jointly normal, then you can work with two popular models. One is the constant mean model, second is the market model, which is the CAPM, okay? And again, these are just econometric issues. I'm not going to delve deep here because, again, it will open up a Pandora's box. There will be arguments and counter arguments. I don't want to get into that. But still, if you're interested, you can go through. This is just a public document. You can just go through it, okay? A constant mean return model would be specified something like this, which is what we started with, okay? We specified this model. So this is a constant mean return model. So here we are saying the first part, which is the expected return, is nothing but it's constant. It's supposed to remain constant, mu. Okay, it's independent of time, doesn't have a subscript time t, neither has it subscript for, let's say, cross-sectional variation I term here. Okay, so it's constant, both across time and across entities. Okay, and expected value of this zeta is 0, and variance is sigma square. So you can note this is not homoscedastic, it is heteroscedastic because the variance is supposed to change, okay, with entity. I think it's supposed to change with time. I would have to check whether I have specified the model correctly or not. But nevertheless, it's more of a econometric issue. When you get down to work, you need to check these. These are routine issues you have to face as a researcher. So I'm not emphasizing much here. Second model is market model, when you just augment that term mu, which was earlier time independent and entity independent. Now I've just subscripted it with a term I, which means it is firm specific, okay? And I've specified the market component, beta I times RMT, which makes it a CAPM model, right, in some way. Again, this is the expected value of the error term and the variance of error term. So these are two popular statistical models. It's not just that you can just work with this. You can work with APT. You can just work with Farmer Friends 3-factor model, 4-factor model, 5-factor model. Okay, you can just work with any benchmark model that you would want to. This is what a Farmer Friends 3-factor model would look like. You just augment this market model with two other terms, SML and HMB. SML and HML. Actually, it's more popular SMB, so I think it's SML. Doesn't matter, small minus big and high minus low. Okay. This is just a sorting, a portfolio construction, nothing much to discuss. Estimation of abnormal return. Now that you understand that you have a benchmark model, you know what is normal. Now it's time to find out what is abnormal. Okay. So naturally, what you do is from the actual return that's realized, which is Ri, you take out the expected component that would leave the unexpected or the abnormal component. Which is what you see on the slide. Okay, so ARIT is nothing but the abnormal return, and just cumulate it over your event window. Event window you can construct on your own, depending on what you are actually intending to do, depending on your design of a study. That cumulative abnormal return is just cumulated. That means you just sum up and abnormal returns over different days. Okay, it could be summed up over, let's say, -2 to +2. It could be summed up from day 0 to day 3. You can do anything with that. It's up to you, depending on what your design of the study demands. You come up with CAR, okay, which is nothing but abnormal returns cumulated over, let's say, K days, K calendar days. That's what is written there. Okay, and statistically speaking, this distribution of cumulative normal return, it has to be normally distributed with mean 0 and finite variance. Okay, so CAR would work fine if you are dealing with the first kind of study, which is short-term studies. If you want to do long-term studies, then typically what researchers have found is BHR, or buy and hold abnormal return, will tend to perform better. Okay, in which case you have to calculate BHAR, not CAR, cumulative abnormal return. You have to calculate buy and hold abnormal return, which is how you calculate this. Your abnormal return calculation stays the same depending on what your model, benchmark model specification is. You calculate that from the realized actual return, you take out the expected component, you get the abnormal return, and then you just add 1 to that and multiply this. This pi is nothing but this is product over k days. So 1 plus AR1 times 1 plus AR2 plus 1 plus AR3, assuming you are calculating buy and hold return. This is you are buying and holding it for 3 days. So this is how your calculation would be. Okay, so now what I'll do is I'll just quickly walk you through the implementation in R. It's not working. What has happened? This one? Is it disconnected? Just check. Thank you. So what I am going to show you is a simple implementation in R. I hope you are aware with the R Studio interface. This is a simple software. Everybody, all of us use it. So I'm not walking you through the interface. You're familiar with this. However, what I'm going to do is I'm going to show you, I have downloaded some data file. I'm just going to run quickly in next 5 minutes and just show you how easy it is to actually implement this event study. So what I'm going to do is my event here is stock split. Okay, like I announced, there could be multiple corporate events for which I can implement this kind of design and analyze what is the impact on return. So I'm just using this. So the data is here in front of you. These are some Indian companies, BHEL, Bharti Airtel, Cipla, Coal India, and supposedly these stocks announced splits on these different dates. Okay, for example, BHEL, Bharat Heavy Electricals went for stock split on 3rd November 2011. Okay, and likewise, the data is self-explanatory. There's nothing much to explain there. It's just that stock split we understand, right? The nominal value of the stock actually diminished, right? For example, the stock earlier was trading with a face value of 1,000. With a 1:10 stock split, the new stocks will have a face value of 1,000 by 10, which is 10. Okay, this is one thing. The second thing is stock price returns. So now that I want to analyze or examining what impact the stock split would have on, let's say, stock prices, I need to see what are the returns of these stocks. Okay, so what has been done in this Excel, return itself has been calculated. You can just go back one step and calculate the raw data. But that will present one problem, that when you calculate the return, you will face with two issues. One is, how do you calculate the return, whether it's a geometric return or simple arithmetic return, that's one. Next is you would have to take care of corporate events. For example, you would have to adjust for any dividend announcements, stock splits, or any other corporate announcements, okay? So lucky for us, we don't have to bog our heads with these issues because we just have the returns, daily returns. So on the first column in A, we have the time, daily time, okay? And then on subsequent columns, you see returns for different stocks, Bajaj Auto, Bharat Electricals, Bharat Heavy Electricals, Airtel, Cipla, Coal India. And in few columns, you see NA, which means either the stock was not trading on that day or, yeah, I think most likely the stock was not trading on that day. Okay, you need to check what was happening. I think Coal India got listed much after 2010, if I'm not mistaken. Okay, that's why we see NAs here. On the third data file, we have other returns. For example, why do we need that? I clearly mentioned that we need to specify a benchmark model. That benchmark model could be either a constant mean model, it could be a CAPM, or it could be a model augmented with multiple variables. So in which case you need that data as well, and therefore I have this Excel containing that data. So what I have in this data is basically the index return, which is Nifty returns, and then you have the call money rates, okay? And then you have the broader index, which is S&P 500, and then you have the exchange rate USD INR pair. Okay, so this three returns I have. So what I'm going to do now is I'm just going to call all of this data in R. Okay, so I need to install few packages, so I'm going to skip that. Okay, because installation it may take some time. I've already run that code once before coming to this session, so I don't need to waste some time there, so that saves our time. I install two packages, one is digest, one is GitHub install. Why I need GitHub install is the package that I'm going to use, which is event study for this analysis, is not a standard package, which means it's not available directly. Some user has written this code for event study, which is available on their GitHub page. So GitHub install will help us fetch that code from his account. So therefore we need this GitHub. Once I have the GitHub installed, I need to download event studies from that GitHub page, which is what that code at line 9 does, okay? And it forces to true, which means you have to forcefully install all the library dependencies, okay, without asking the user each time, okay? And then I just call the library for event studies, which is what is done in line 10. Once I have the data, I just load in the three data that I showed you separately. One was the data on stock prices, all the stocks, the data, that file I showed you, I'm just calling it here. The second is the split dates. So these are three files, just remember. R will actually collate and mix and match, do everything internally. We don't have to bog our heads there. Data on stock splits and data on other returns. Once I load all the three data in my R, I can just have a look of what I think I have to run it again. Let me run it again. It will just take a minute, so just please bear with me. It will just take a minute. I think I need to just I think something has happened. The code is not working. Sorry for that, because but just before entering the room, till that time the code is working. I don't know what has happened. Suddenly some libraries have changed. Something has happened. I'll try one more time. But it's pretty simple. It's pretty simple. Maybe it may want to restart the R one more time.
Sir, one quick question.
Yes, please.
You have taken how many data points for this study?
This is a very, very hypothetical data, so
I can see very few observations are there.
no, it definitely has ample observations, enough to actually carry out a meaningful statistical study. I'll just let me count that in front of you.
You can just click on
22, yes, 22 events. So 22 events itself is much, right? Because we are talking about event study design, okay? And 22 means 22 companies are there. Yes, yes.
for how many days have you collected?
I think it starts from 1st July 2010 and goes to 2013. So it's almost like 3 years. 3 years. Daily data. Okay. So that's actually for illustration purposes more than enough. I think, yes, it wanted my, see, this is the issue. It wanted my intervention at this point. I was distracted, so I could not, yes, I have to say yes. So this is the issue. So there are some, see, once you get down to actually doing the study, you will face a lot of issues. So sometimes issues like this is very common. We researchers face every day in our life. The code that was working an hour back will stop working an hour after an hour. So you just have to be at your toes. Now I think things will go smooth from here. Yes, things will go smooth from here now. Okay, so what I'm going to do is I'm going to load the three data, the three files that I showed to you. One by one I'm loading it. Okay, and now I'm going to just give you first 6 lines of each of these files. Anyways, you have seen that file in Excel, but in the interface itself, you can just have a peek, okay, what that file contains. So this is what the file contains. The first one was basically stock price returns. So you can see for first 7 days, it shows you stock returns for the different companies that I have, 22 companies, right? Similarly, we can have a summary. Okay, so it will give you all the statistics, median, first quartile, second quartile, third quartile, maximum, and you can just customize this depending on what exactly do you want. Similarly, I can show you the first 7 lines in the next file and the other returns file. So these are the things. Now what I'm going to do is I'm going to specify my model here, which is what is done over here. So I'm running an event study, okay? Event study itself is a function and it takes a number of parameters. As we can see, I fed with returns parameters, stock price returns. The second input I fed with what are the events, which are the split dates. Third is what is my event window. I can customize it. Okay, here I have chosen a 7-day window. You can work with a narrower window, let's say a 3-day window, or a wider window, let's say a 10-day window. It's up to you. Okay, so I have quickly run the model. Yes, the model is, I think, run. So I can just quickly look at the plot. Yes, so this is the plot. I'm just going to zoom in. So this is what I was talking about. We have an event which is stock split. Okay, I want to understand how this stock split affects the stock prices of the different companies. I have specified a 7-day event window. So you can see time 0, which is over here. Yes, which is over here. If you specify this as an event 0, look at how stocks have moved. Stock returns starting from day -6, which is 6 days prior to the announcement of stock split, stock was kind of hovering around the 0 line. So it was kind of flat, okay? Suddenly at the day of the announcement, the stock plummets, okay? And then post the announcement day, which means let's say 2 days, after 3 days, 4 days, and 6 days, stock starts rising, okay? You can see that for yourself, right? And the 2 other lines is basically, I think, confidence intervals, okay? So this is just one part of estimation. What I can do next is I can just change my benchmark model. Okay, this was, I think, a simple CAPM model. I can just augment it, use other models as well, which is, I'm not going to go there because it's very simple. Ultimately, you will get to see something like this. After this, what you can do is you can actually test, you can calculate your abnormal returns. You can work with your CADs and BHADs, which is buy and hold return, and use a simple t-stat6 to see whether your abnormal returns and cumulative abnormal returns are statistically different from 0, right? So which means now you'll have to do some manual work. You have to collect all these abnormal returns over different windows and just run a simple t-test over that to see whether it's statistically different from 0, okay? So that's how simple it is, okay? Thank you so much. Any questions? Any questions? I'll be happy to take few.
I have a question.
Yes, please.
In addition to our software, can you use any other software to find SAS also?
Yes, you can use multiple statistical packages.
SAS is very costly. It is not easily available. R is free.
R is free. That's the reason
Or SAS or some other are also there, but basically maybe these both are popular.
you can work on Stata, which is relatively cheaper. That's the only reason I chose to work on R, because it's free version. You can just work freely, and codes are also freely available.
Sir, I have a question regarding event study.
Yes, please.
If there are multiple events happening very few in time period interval, like purchasing of stocks by promoters, then how can we estimate our event study?
See, a very, very good question and a very practical question. That's the reason I have been saying this from step one, right? That means everything that you do has implications. From an econometric point of view, it will have implications. Questions will be asked. Questions will be posed on your design, right? For example, like you have rightly pointed out, how to design an event study around an event which is like so clustered together that you are finding it very difficult to actually isolate those effects. So I think there are various studies that have done it. Okay, you need to have additional controls on standard errors. Okay, you will do clustering on errors. There are other statistical techniques which actually addresses those kind of problems. I'm sure if there are problems, there are solutions as well, right? Thank you.
Yes, sir. Thank you.
Hello, sir. I have a doubt. Thank you for the wonderful presentation. So, while doing event studies, how will we attribute, like we are studying the nature of returns pre and post event, but how will we attribute that the nature of returns has changed only due to this event and not due to other factors?
So that's the reason we have to specify our benchmark model very, very appropriately, because the idea is, if you have specified your benchmark model with adequate number of regressors, the event or any external, let's say XYZ factors that could potentially affect your returns will already be controlled in the in the benchmark model, and therefore what is left out is solely happening because of that event. Okay?
Thank you.
Thank you.
Good evening, sir. Here.
Yes.
Sir, amazing explanation. Just wanted to clarify, in the R code, where did you specify the model?
Yes, it was specified here. It was specified here. This is my
Like suppose I want to take Pharma Macbeth 5-factor, 3-factor,
Yes.
right? So in that case, I guess you have taken Capum. So
in which
where
case,
did you?
in which case you have to just tweak. It's more of a coding issue. For example, in this case, what I'll do is I'll have a vector of, I'll create a vector in which I'm going to store what other things that I want to specify. For example, in other returns, I will have to, let's say, SMB factor, HML factor, I'll just store in that vector.
Okay. So it will be just adding on
Yes.
to all these.
Add as a new column there.
Okay. So like SMB, HML, all we'll
Right.
add in the same line.
Yes.
Okay. And with respect to the arrangement of data, suppose I am interested in studying the external events, for example, COVID-19 or Russia-Ukraine war. So with respect to all the companies, what is the date? Because it will be the same date, right? Like for this stock splits, for every company, it's a heterogeneous dates. So if we register for the macroeconomic factors, it's the same, right?
Yes.
Okay. Just
So it's more, the question that you are posing is more of coming from a design perspective. So you just have to tweak the design. What I am trying to do, I have tried to do is I just try to give you a broad skeleton, try to help you understand how do you design, set up your design.
Okay.
Okay. Thank you. Thank you so much.
Thank you, sir.
There are some questions from online participant Megha Rani Patel.
Okay,
we are not able to display it right now on the screen, but I'll read it out. Sir, in India, how to get SML and HML values of companies? This is the first question.
Yes. So answer is very simple. IIM Ahmedabad maintains a library of SML and HML factors, both on a daily frequency as well as a monthly frequency. So I would request the participant to check IIM Ahmedabad website. The data is again survivorship bias adjusted as well as the raw data. So actually the data is pretty much detailed. So almost anything you would want to do, IIM Ahmedabad has the answer. Okay?
There are some other questions as well from Megha.
Oh, yes. Is there any database which gives us these values for the listed companies? Which values, if I may ask, which
That
values?
same.
So that IIM Ahmedabad library, yes, that has been answered. In after event study, when we run regression, can we have multicollinearity problem among many variables for these cross-sectional data? See, these are econometric issues. You definitely would deal with these type of issues. So just working out with an event study doesn't give you a scapegoat. You would still face a lot of these issues, multicollinearity, heteroscedasticity. These issues will be there. And lucky for us, we have ample number of research studies that have actually come out with ways to tackle with these econometric issues. So that's the answer, right? Anything else? Okay, I guess that's it. Thank you so much.
So thank you, Professor Kamran and Professor Arun, for the wonderful presentation. So we are just going to end this workshop, the doctoral workshop right now. So you have half an hour free time, okay, the doctoral students, and after that we are going to start the doctoral presentation starting at 6 o'clock. At the classroom. So the doctoral conference or the doctoral presentation will start happening from the classroom. That is our academic block 1 or block 2, right? Yeah? Okay, so thank you for all your participation for the whole day. And thanks all the speakers definitely, you know, and all the staff members who really worked as students. So thank you all, yeah.
If you get lost and you are not able to find your classroom, please contact the track coordinator. The phone number will be given. In case if you don't have that phone number also, at least remember your session ID. Like there could be sessions like OM1, OM2, something like that. So wishing you all the best for your presentations. And with this, we end our doctoral consortium's second part. So the third part will begin at 6 p.m. Thank you.